Thanks for joining us today on Market Call. I'm Morella Fernandez. Darren Sissons on the show with us. He's partner and portfolio manager, Campbell, Lee and Ross Investment Management. He'll take your questions today on global and technology stocks. Here's how to reach us. 1-855-326-6266 if you'd like to call in. You can also email your questions to marketcall@bnnbloomberg.ca. Darren, good to see you. Thanks for coming in.
Yeah, good to see you again.
Up and down for energy stocks for the past 2 months plus. With those stocks, have you been trimming at this time, dipping in to buy more? What are you doing?
Yeah, so I think that let's use Suncor as a good example. Around the $92 range, it looked definitely overbought, so we trimmed up around there. We have taken some money off the table on 2 of our oil holdings, and perhaps sporadically in other areas. But this is going to be a big year for everybody paying taxes come March 2027, because what's happened is everybody has exited growth segments, particularly software that looks under pressure from AI. They then went into oil, so you had the tax related to the software and perhaps growth names, even to crypto if that's your category that you play in, and then ultimately back into oil, and then they trimmed it. Now, if the president actually goes ahead and ends the conflict as what the narrative seems to be at some point, then we'll see energy retrace. So you've had a cyclical category that's moved up, obviously with defence. It's a conflict beneficiary, and ultimately what we've seen is it's been a great way for the governments to harvest taxes off people, because if you move from winners to winners, you've got to pay taxes on the way through, and that gets picked up in the new year. So I think tax is a large unappreciated risk that people should be thinking about come 2027.
Okay, so midterms, of course, later in the year. We haven't touched on that in a while. I'm just wondering if you see, or how you see, the U.S. administration trying to ensure that markets stay strong. Yeah,
so I think that's a very important point. So obviously, the president's approval ratings have fallen to, depending on which metric you look at, but 30 or definitely below 30%. And so obviously voters at the ballot box are going to reflect higher energy prices and general dissatisfaction, perhaps job losses, a tougher job market, and then the transition to perhaps temporary employment as opposed to unemployment or loss of full-time jobs. So where that ultimately translates is that the president does not want to become a lame duck. If he loses control of either the Senate or the House, in effect, he will then have to default to executive orders, which can be replaced as soon as he leaves office. So he will do whatever he can. The monetary policy, I think, is not a lever he has control over. So like last year, we'll see an expansionary fiscal spend moving forward. And obviously, conflicts are inflationary. That kind of capital makes its way into the economy, and that's why we're seeing the markets at very high levels at the moment.
You don't think he'll put pressure on the Fed to lower the rate?
Oh, he's going to do that for sure. But when you have at least the illusion of independence from the Fed, you've got Kevin Weish is there, I think he's there now, or effectively in waiting. And then what you actually will see is perhaps less ability to get done what he wants. He's obviously picked people that he wants in there. But ultimately, his big lever is fiscal. So he can shovel-ready projects, spend on that basis. And he doesn't really need to take heed to what the Fed actually says.
Let's talk about sectors you like. You wouldn't put new money into energy, I take it right now, considering how volatile it's been and perhaps seeing an end to the conflict. Where would you put money?
So, I think on energy, unless there was a significant escalation, we might perhaps consider allocating for a trade. But I think given that we're 3 to 5 year money in terms of our investment outlook, that's not where we would play. But I think where you want to be doing is you want to be taking the dry powder you've taken and push it into segments of the economy that have been depressed. You've got the AI overreach, which has really gone too far for many companies. So software looks interesting. Healthcare, Medtech looks very interesting. And from a global perspective, luxury looks very inexpensive. So if you look at like Louis Vuitton, Hermes, even L'Oreal, they look quite interesting. And obviously some portions of the industrial market, particularly companies in the industrial space that used information technology or IT resources, they've come under pressure as well.
Okay, let's take a quick break. We'll line up some phone calls and some emails for Darren Sissons. He is of Campbell, Lee and Ross Investment Management. He'll take your questions today on global and technology stocks. Here is how to reach us again. Back in a moment. Welcome back. Thanks for joining us. We have an email from Chad who says, what is your opinion on ISRG, which is a surgical instruments company? Darren, do you know this one well?
Intuitive Surgical? Yeah, I know it pretty well.
Okay.
So as a general rule, Medtech has been hammered because as funds flowed out of growth sectors, what they did do is they then flowed into the conflict trade, which was defense and energy. So what I would say as a general rule, a general guidance, I think I think investors with longer term money, they should be looking at the medtech space, and there are a number of different opportunities. Now, this is a very good company. It's generally been high growth. Think about it as robotic aided surgeries, and so that's actually a category. So everything when you're looking at companies that are patients or treatments that require very precise, like spinal, brain, that kind of thing would be the kind of applications that they would use. And then it obviously has a very good recurring base, as most recurring medtech companies do. So I like the company. I think it's actually quite attractively priced here. We have some medtech on the books at the moment. We've added it relatively recently, so we probably wouldn't chase this here, but if it came down a bit further, I would look at it for sure.
Okay, let's move on from the email to our first caller. Deborah's on the line. She is in Okanagan Falls in BC. Deborah, go ahead.
Oh, hi. Good morning, Darren. Love it when you're on the show. My question today is on Qualcomm. It's showing a 52-week high today, up close to 10%. And I'm a chart reader, and it looks like the share price is reaching the May-June 2024 high before it started taking a downturn. So my questions are, what are your thoughts on the fundamentals of this company? Because this is showing a really steep incline in the price right now.
Okay,
Yeah.
Thank you for the question.
Okay,
That's its
thanks,
AI
Derek.
narrative?
Yeah, so the chart tells you everything you need to know. So I think you could replace it, and perhaps you could even look at overlay, say, SK Hynix, which was, I think it's 400% up in a year, depending on where you draw the line. So the problem with anything that has any smell of AI, you've actually seen that kind of inflection. No, I think, to me, that just screams .com 2000 all over again. The anticipation, the expectation of what AI is going to do, I think the equivalency is the world has just invented the wheel. It's made of stone. It's been chipped out. What AI ultimately become Maserati is very, very different than what we have now. 20 years worth of AI. So the promise of what AI is meant to be now and what it's actually delivering is a complete disconnect from what the market is assuming it to be. We can go on and we can do some chat GPT, great. Okay, so now I've got an idea. But is that going to fundamentally enable us to develop new medicines at a rate of knots and things like that? Yes, but that's obviously further in the future. So at these levels, I think you need to be taking profits here. Like, I would not be allocating any money to Qualcomm here. And
Would you take profits? Would you exit your position?
I'd probably exit, actually. Yeah.
All right, that was for Deborah. Let's go on to our next caller. Wes is in Campbell River. He's in BC. Wes, go ahead.
Yeah, hi, good morning. I was calling about GLW Corning, and they are doing a lot of fiber optics, replacing internet cable lines, and then with all the new photonics and optical tech that NVIDIA is doing. Just wondering what your thoughts are on this company going forward.
Yeah. So I would reply with a couple of things. So I will quote a prior boss. And one of the comments he made was, don't confuse a good company with a good investment. I do really like Corning. But as you see from the chart, just look at the inflection that's gone on in 2025. I've owned it a couple of times. And I think what you want to do is you want to buy it when it's inexpensive. But the problem is, as you can see from the chart, and it's a little skewed because of 2026, but what you want to buy is you want to buy it when it's dead money, a dividend around 3 to 3.2%, and then you want to hold it. And then periodically you get these inflections, and you get huge inflections. So the last time I was in it, I think the entry level was around $25. So had we not sold it, that would be a very substantial gain here. But would I allocate capital to it now? despite everything that I like about the company, the answer is no. I think you need to trim and you need to be disciplined here. Do not chase companies that have hyperbolic, verticalized charts. You're just asking for trouble, especially if you're late to the trade.
If it comes down, is there a point you would enter or re-enter?
Well, if you go back and look at the chart, you look at the inflection, how much does it have to come down before it becomes an attractive trade to hold for a multiple period of time? So if you held it from, say, 2022, then you'll be very attracted, you're very happy because you've had a dividend, you've had a capital gains appreciation, and then you probably trim it, right? Whereas if you are buying it and you bought it at 150, okay, now you're not playing with the house's money. The 2022 trade, you're playing with the house's money. You can trim it a couple of times, you've done really, really well. When you're up around the 150 or even above 120, you're waiting for someone to take you out at a higher level. So that's a Ponzi trade.
Let's leave it there. That was for Wes. We're going to move on to Paul in Edmonton with his question. Paul, go ahead.
Hello. Yes, I'm a very long-term buy and hold value investor. I've been looking at Brookfield Infrastructure Partners. But when I look around the internet, Brookfield Infrastructure's PE ratio seems to be between 40 and 55, depending on where you look. This PE seems to me to be too high to be a good value. But what do you think about this in Brookfield Infrastructure Partners?
Thank you for the question.
Yeah, I think it's a good question. So I think there's going to be an infrastructure spend. And I think there's an infrastructure deficit. You just drive around Toronto, look at the roads.
That is true.
Yeah, and for example, you look at, what Australia has done. Every now and again, when they run into an economic issue, the sovereign funds spend money and they do big major infrastructure projects, like the Sydney crosstown tunnelling system. It's a huge spend, very stimulative for the economy, and so obviously great value for the economy as well. So I do like the category. Now, the challenge I think you've got with all the multiple entities of Brookfield is that, why not just pick the parent? You're going to get the benefit of all the others. You're going to get a much more diversified end vehicle. And, Brookfield is itself is actually on sale, and I think it's relatively inexpensively priced relative to some of the entities. So I would say if you're looking at Brookfield, now's a fairly inexpensive time to buy it. And you could probably buy it, given the backlog and assets under management and all that, you could probably buy that here. If that's not what you're going to work, then you'd look at, say, some of the US alternatives, like KKR, which has had some issues with regards to private credit, so that will sell off in a business. You've got Carlyle, you've got Blackstone. There's a number of different opportunities. And so I think the trade is effectively the same. And
you get a 5% dividend almost with Brookfield Infrastructure.
Yeah.
Okay. All right, let's take a quick break. We'll get to more of your phone calls with Darren Sissons of Campbell, Lee and Ross Investment in just a moment. Stay tuned. Welcome back to Market Call. Bob's on the line. He is in Bowmanville, Ontario. A question today for Darren Sissons. Bob, go ahead. Bob, are you there?
Yeah, hello.
Hi, go ahead.
I wanted to ask about stock that often gets talked about here, Novo Nordisk. It's had a nice little uptick here in the last month, but over the longer term, it's been certainly been beat up. And often when it's discussed, Eli Lilly comes up. So that's a comparison. But just your thoughts on Novo going forward.
Thank you for that question. I guess that's the question of who's winning the drug with the weight loss drug.
Yeah. Let's look at a longer term chart, if we can. At least go at least 10 years. Yeah.
There's 5 years.
So we bought it just before the Trump first presidency, and we made out very, very well. I think at the peak it was a 7 or 8x for us, and we completely cut it every time because the problem is with drugs. Drug development companies, which effectively Novo Nordisk is, you run into an issue where a competitor come out with a slightly better drug and then it gets cut. So we're completely out of it now. It was from a tax point of view, painful because we had to sell it. People had very big gains. But ultimately, the point that I would say is now I think the headline news on Novo Nordisk is significant and it's just coming in waves. And I think that the likelihood of you seeing any benefit in terms of significant movement up in the share price is not high. Now, the difference between Novo and Lilly is not substantially so. There's obviously a benefit in Lilly's favour, but that's just currently. What happens if Novo comes out with a new product? the headline risk will still depress it. So what you want to do is you want to wait out the negativity and then recognise that Novo's still going to grow at double digits in terms of product cycle. So I like the company long term, but we probably wouldn't go there again probably for another 5 years.
Let's go to the next caller. Then Harry's on the line in North Battleford, Saskatchewan. Harry, go ahead.
Yeah. Thank you for taking the call. I would like the gentleman's comments on MU.
Micron. Okay.
Micron.
Thank you for the question. Micron, let's have a look at that chart. And yeah, also a decent run up.
The same chart, right? So here's the challenge, right? Micron, let's call it loosely, the beneficiary of AI. And the market's just being bid.
It's a tight market.
It's a very tight market. There is no sellers in this name. There's not much profit taking. So the question you got to ask yourself is, do you want to buy a chart buy a company with a chart like that? Like, what is the likelihood that it's going to double from here? And the answer is probably not very high. So if you're in there, take some profits. But if you're looking to get an extra 10, 15%, it's a risky place to be. You could probably get more out of the previous Brookfield infrastructure partners. You'd get 15% over 3 years just holding the dividend. So I wouldn't be buying this here. I would definitely, in fact, if anything, any market catalyst, and this is a short, right? So this is not something that I would invest in.
Let me ask you, if you were already holding it, and as you said, good time to trim, obviously, is there still some run up to gain with the tightness in that market?
So I think what you need to think about is what drove the inflection. So the inflection was a weakness in the memory market last year, and you can see a number of different companies that have benefited. SK Hynix would even be better, 400%, I think, in a year. So the question you've got to get to yourself is, okay, given that you've got a cyclical category that has these wild swings, do you want to be investing at the top of the cycle or the bottom of the cycle? And I would say you make money when you buy. So you buy at the bottom of the cycle and hold. If you miss the cycle, wait till the next one, because it's a very cyclical sector. And when the markets come down for that sector, then you will buy it. And I would say pay attention to the semiconductor capital equipment companies, because they lead these semiconductor companies by about 6 months. So when they start to trend down, then you know the trade is coming down for the semis.
Let's go to the next caller. Then Jonathan's on the line. He's in Toronto. Jonathan, go ahead.
Hi, Marilla. You did a great job, by the way.
Thank you.
My question is more a macro level question. We have a lot of guests that come on that are like technical analysis or momentum, or like yourself in value. So when does value investing add most value? Is there certain cycles or certain years where you can speak to that, say, hey, these are great times where we've seen times where we've outperformed the benchmark, and other years where it might not be as effective?
Yeah. Okay, Jonathan. Yeah, so I think that's an interesting question. So I think for the last few years, definitely as we've seen significant money printing through either quantitative easing on the monetary policy side or fiscal spending more recently, putting gasoline into the markets at a high level just moves the markets higher. So that favors growth. Now, if you look back to 2008, 2009, when growth came out of the market and the market collapsed significantly, the value market significantly outperformed. So I would say perhaps the way to think about growth is when do you want to add growth, when do you want to add value? And so value names are very inexpensive now. So if you're looking to add portfolio ballast into your program, then what you would do is you could buy the staples now because they're very inexpensively priced. And you would then increase the amount of income coming through your portfolio. So your classic P&Gs, your Clorox, your Colgates, Unilevers, Danones, that kind of thing, Nestle. And what that does is all the staples, and you're doing that at a very inexpensive price. When tech crashes, then you do the same thing. So you're constantly moving your capital from expensive to inexpensive names to build a sustainable wealth development. And if you do that correctly and you get the timing right, then what you can do is you can avoid major drawdowns, but you can also get fairly consistent growth. So we're not really value investors. We're more growth at a reasonable price investors, but we do occasionally add growth and we do occasionally add value.
Let's take a quick break on that note. We're going to come back and have a look at Darren's past picks. That's up next. Stay tuned. Welcome back. Time now for a look at past picks from Darren. May 16th, 2025 was when he chose this, so just under a year ago. AstraZeneca was at the top of that list, AZN on the NASDAQ, 10,033 at the time to 13,374, so 29% upside, 31% total return. What does AstraZeneca have going these days? Because I still think of it as the COVID case for them and sort of slack after that.
Yeah. So what I would say is, given the amount of AI sort of discussion we've been having, I'd say what viewers want to do is they just want to type into their AI algorithm of choice. Why will AstraZeneca's revenues double through 2030? And it's a little bit dated, but they've had 6 drugs been approved in the since 2024. They've got 2 drugs approved, being approved probably in 2026. So they've just got a very well advanced stage pipeline, which is going to add significant revenue top line. So they will move from $60 to $80 billion in revenue come 2030. Now, the interesting thing is from 2023, revenues have moved from $5 billion to $10 billion. Sorry, profits have moved from 5 to 10, so double in 3 years. So if these drugs become successful, widely commercialized, then you're going to see a significant uptick in profitability. And I don't think that's fully priced into the stock. So
what kind of drugs are we talking about? They have to be mass market drugs.
Yeah, like oncology, you've got rare drugs. But I would just encourage viewers to take a good look at ChatGPT. It lays it out very, very clearly for you. Even Google Gemini does it as well. So the story's there. It's a good story, and it's a lot more than infectious diseases.
Okay, let's go to your next past pick. Canadian Pacific, Kansas City, the rail lines. That's what you chose last May at 114. It's up to 116.19 today. Return of 2%, 3% total return. Are you staying in rails? What's your theory moving forward?
So what's interesting is obviously it got hit by the tariff narrative, both it and CN Rail. And I think what we have seen is there was very little fundamental impact on what the tariff narrative did to the stocks, because the integrated nature of North American rail, I mean, if you're in one portion of the US, your choice is either a rail or a truck, or a Canadian rail or a US rail. So the integrated nature means that tariffs are largely irrelevant. So I think that's the first thing. Both CN Rail and CP raised their dividends. So what we may see is if when the tariff, the North American trade agreement is renegotiated starting in June, we could see some weakness here. But if you look long term at the chart, historically it's been a very poor mistake not to add either CN or CN on weakness. So if they get weaker, we would add probably in size. But I do think that longer term, this is a great story. Dividend buybacks, increases, and I think logistics generally is very inexpensively priced.
Let's get to your next past pick from last May. Lind PLC. At the time, it was $457 US 77, up to $494.52. So 8% upside here. A total return of 9%. Do you remember why this was the pick last year?
Yeah. So if you look at the long-term chart, that will tell you why. And I'm talking multi-year chart. It's been a very solid performer. But I think for viewers, what they want to do is they want to just type in, again, ChatGPT or whatever it is, and decide how big a beneficiary Linde will be from the redevelopment of the Middle East following the conflict. Meaningful. So oil refinery exposure, you've got carbon capture exposure, and that's in addition to the new backlog. It's a dividend aristocrat. I think 30 consecutive years of dividend increases, an annual buyback. So again, look, I wouldn't say this is on sale, but I don't think that the share price fully reflects the upside ahead. So we like it. We think it's great. And from a cost-based point of view, we're sitting on a multiple of our cost base already.
Let's take a quick break on that note. We're going to be back with more of your questions for Darren in a moment. Stay tuned. Welcome back. Sydney has written in saying, please provide your analysis of Tilray Brands, TLRY. Also, what is the mid and long-term outlook? So this is a cannabis company, but they've got sort of other irons, I guess, in the fire. Do you invest in the space at all?
So, we're open to any sustainable opportunity for wealth creation. But I think if you look at the chart and you can just see it, when Peter Thiel was there, was it October, whenever that was, then it was a great story, but you actually sold into the IPO, and then it's really fallen ever since. And I think all of the cannabis companies have done exactly the same thing. And there was a little bit of a jump when the Trump administration were talking about potentially legalizing it.
Yeah, reclassified some of it.
Yeah, but the problem is the US names would offer significantly more upside than the Canadian names, and you've got it really is active. So if you're looking for this kind of risk, I would say look at Verano in the US, but I wouldn't be touching any of the Canadian names here. I think it's effectively becomes a tax loss if you're going to buy it myself. Let's
go back to the phone line then. Bob on the line in Brighton, Ontario. Bob, go ahead.
Hi, guys. Great show, long-time viewer. My question is on Campbell. Darren, if you could give me your thoughts. They just came out with their earnings. And yes, I am long. I'd like to hear what you have to say.
Thank you for the question. Cameco uranium play?
Yeah. So a couple of things. So we have some Cameco bonds. And so I think we haven't pulled the trigger on the equity. And I think that if you go back even further, it was dead money around $12, $14 around 2019. And the challenge that you've got here is obviously there's an energy driver, but there's a complete disconnect between a 10-year horizon for the contracts and what the current spot is or spot price is for uranium. Now, given that you've got 10-year contracts in inventory, what is the likelihood that the current spot price is going to be the price going forward? At the margin, 1/10 the price, but is that actually showing up in the profitability? And the answer is clearly no. So you can see it's been dead money. So I think as a category, if you've made money at great, well done, you've done great. But like all commodities, they tend to overshoot in either direction, and then they can be range bound. Gold will be a classic case. Over 25 years, it was dead money for 23.5, and then in the last 18 months, it's really rewarded very well. So if you've made money on this, great, but we would not be adding exposure here at these levels.
That was for Bob, but let's go on to Charles. He's in Oakville, Ontario. Charles, go ahead.
Thank you for taking my call. I'm curious on your thoughts on WSP Global. I know they reported the other day, and I'm wondering what your thesis is for the near and long term. Thank you.
Thank you for the question. It's tracked down quite a bit to 219.
Well, it's not in the conflict space, is it? It's not a conflict trade. But I do like the construction business. Mm-hmm. I think that when we think about the infrastructure spend, the noise that is coming out of the Prime Minister suggests that we're going to see some infrastructure spending. So perhaps WSP captures some of that. But the risk, of course, is always what happened to SNC, whatever it's called now, and in terms of that.
Atkins Realis,
right. So that I think is the challenge. But, we have very little bit in the system. Some clients that moved on have kept it, have very big gains. So if you own it, great. I think it might have some runway here, but we probably wouldn't add it here. It's not. It's a little too perhaps cyclical for what we do.
Would you go to another name in that space on the idea that there will be a build-out?
I think the term shovel-ready really needs to come from mind, and that was what Obama said when he came to power. And then what we found was there really wasn't a lot of shovel-ready development done under his regime. So again, in the context of Carney, there's been many announcements, potentially a pipeline through to the Arctic. Okay, if that's going to happen, then we'll buy it. But just stand and build a new road here and there, that's not going to move the needle massively.
Let's go to our next caller then. Harold is on the line in Montreal. Harold, go ahead.
Thank you. I have a question about Pfizer. I've acquired at considerably higher price than it is today. And my question is, do I simply sell it, take my loss, buy more and average down, or should I just sit on it and wait for it, hopefully, to come back? What are your thoughts?
Thank you for the question. We're talking about AstraZeneca. What does Pfizer have in the
pipeline? So in the context of, I think healthcare is cheap because it's not part of the conflict trade. Mm-hmm. I think that's a legitimate point. And so it pays an attractive dividend. But I think what you need to understand with Pfizer is, unlike, say, AstraZeneca, Novo Nordisk, Roche, it's not a company that actually develops it's more of a marketing company than it is a drug development company. So they tend to partner and bring in companies. They obviously do some development, but what you're buying is a marketing engine, and a very successful marketing engine. It is a drug company, but I think I primarily view it as a marketing engine. And so really what you've got here is are they going to do an acquisition? Like, what's going to be the catalyst moving up? And then what happens when peace breaks out in the Middle East and then capital has to flow out of the energy trade and the defense trades? Where does it go to? I think healthcare and medtech is a natural recipient. So look, if you're sitting here and you're collecting the dividend, I probably wouldn't sell it here. I'd probably hold on to it.
And look for a bump after the conflict's over.
Yeah, and then you can sell into strength, right? But you might have to wait a while. But don't everything in your portfolio is not going to be always in the green. Remember, we've seen a big transition, leadership transition within portfolios. It went last year. It was tech, broad tech, semis, crypto, and so forth. And now we're seeing segments that are growing. Obviously, energy, defence. And so as the money's rotated out, it had to come from somewhere. And obviously, healthcare is one area where it came from.
Let's take a quick break. Back with Darren Sissons of Campbell and Ross Investment Management, taking your questions on global and technology stocks. Back in a moment. Stay tuned. Welcome back. Let's go to Rob. He's in Montreal. He has a question today. Rob, go ahead.
Hi, Marella. Hi, Darren. Your thoughts on Apple for a long-term hold? Thank you.
Okay, I'm interested in Apple because their AI was lagging for so long, and now they're sort of grabbing other people's and putting it on their platforms. But they're doing really well, and I wonder if it's sustainable.
Yeah, I think that's the key question. So obviously there's a new CEO, right? So I think thematically what happened was, I've followed this since '76 or whatever it was. So I've followed the company for a long, long period of time. And so what happened over time is obviously Steve Jobs came back and reinvigorated a new product line. The prior CEO, I'm not sure if the handover has actually happened yet, so we'll say, he came in and effectively monetized and turned a lot of the opportunities that Steve had done before he died into very viable, strong businesses.
Sort of subscription services.
Subscription services, a number of different things. And it worked very well. The stock has obviously worked. So the question becomes, what does the next CEO bring to the table? Is it going to be product development? Is it going to be new products? Is it going to be AI? Like, I haven't seen enough to make a definitive answer on that. But I think ultimately where I come out is, look, it's an ecosystem. You get locked into an ecosystem. Like, I'm finally an Apple consumer, the only person in my house.
You weren't before?
No, I was Android. And the products are more expensive, but the shareability of data, the ability to walk up and share files, all of that. The question becomes, where do we go from here? And so, I think it doesn't really have AI, but it's not really an AI company. So does that mean it should actually trade at a discount because it's not AI? Well, we've seen a number of the charts. What's likely to survive? A Micron chart or a SK Hynix chart with the massive inflections, or Apple moving along at its current clip? So I wouldn't be a buyer here, but I don't think it's a company that's going to be, it's just going to fall away.
If you can believe it, I have an Apple and an Android. It's very confusing. Let's go to an email. Corey wants to know, what do you think about BlackBerry? BlackBerry reported recently, said it's done its turnaround from where it was to its offerings now. What are your thoughts about investing in BlackBerry?
So, like a nice little inflection there. And I don't think that's AI, that's more execution. But it's effectively a security company now. And they had very good security, as we know, because Obama cancelled, when he was in power, he cancelled that lawsuit, right? So the question becomes, is it the cyber security, all the various layers of security, is it best of breed? And I don't think it is. So you've got a number of different companies in the space. You've got Checkpoint Solutions from Israel, which is effectively US listed. It's a great company. So I'd like to see a few more years of sequential wins, a little bit more broader, a 1 year turnaround. Like, if you look at the chart and see what's happened to the company over years, I would have to see substantial multi-year benefits before I would actually pull the trigger on it. So for me, it's a pass.
Let's go to the next email from Gord. What are your thoughts on Netflix? Would you buy or hold? Netflix got the boost after it bowed out of the Warner Brothers bid, but hasn't come back. So what is your look ahead for Netflix?
Yeah, so I think peak Netflix was during COVID. And I think now we've got streaming services where you can get on other platforms. And I think that's a real headwind to the company. They don't have enough content. I know a number of people who have different subscriptions that can get whatever they want. So for a similar price. So, I think it's a good company. It's a good delivery mechanism. So I think they need to start building out their content, a bit more procurement. But I think the headwind of competition and perhaps non-mainstream competition is real. Do you have to go through and use, for example, your Rogers platform, $120 a month or whatever it is, or you can just go get Netflix. You get it free through Amazon. So, I'm not a buyer here. I think the peak Netflix is already done in terms of subscriber levels, and so for that reason, I would pass.
And you think the other streamers are sort of coming up now? What did you think of the bid for Warner Brothers?
I think it was a content bid, and I think that's exactly what they're thinking. So I think that was the right thing to do. The fact they didn't get it is another consideration. But it's not just Amazon. It's not just Paramount. What it is it's, for example, streaming services for example, if you want to watch sport, it's streaming services for
Disney.
families that live in different countries.
Yes.
And you can get different products, and that is leading to a bifurcation of the market that is very cannibalizing Netflix share. So for that reason, we don't really use it in our house, but we obviously have it.
Let's get to one more email here from Jeff. It says, what do you think about MasterCard at these levels? I haven't looked at it now, but we'll pull it up. Visa and MasterCard have been going a little bit sideways, and longtime holders have been wondering what's ahead. Are you in any of the space here? MasterCard today at $4.96.
We own Visa. It's a multiple of cost. So it's a net beneficiary from inflation. Every time either more money gets printed, either for a monetary policy or for fiscal spend, it just continues to blow up the cost of goods. Inflation is very beneficial because they obviously get the transaction fees. So we like it. I prefer Visa. We own Visa. It has more broader offering. You've obviously got Europe as well. And I think this is a kind of company or category that you tend to buy on weakness. But that would only apply to either Visa or MasterCard. I don't really like any of the others but below. I think you've got quality, best of breed with Visa and MasterCard, and then you've got the others. And in terms of Visa, you've got a buyback plus dividend increases. It's just been a very solid performer, and at this point, it's a core holding for us.
Let's take a quick break. We're going to have new top picks from Darren Sissons when we come back. Stay tuned. If you miss Market Call, you can always check out our daily podcast. Find it on iHeartRadio and other platforms. And you can watch full episodes on our YouTube channel. Let's get to some new top picks from Darren Sissons. We're going to start with Accenture as your first pick. So they do tech consulting, and I know a lot of these have been slammed. Yeah. Is this why you are interested today?
Yeah, look, I think the AI narrative has just gone too far. But, it has a dividend increase and share buyback algorithm, so it will reward shareholders. So at lower levels, that's going to be beneficial. But, the folly of the dot-com era was CIOs found that dealing with small or new companies for a point solution in their enterprise, for solutions that were going to be customer-facing or employee-facing enterprise-wide, was a real mistake. And the thing is, and also chief investment officers are going to need, who are ultimately responsible for IT deployments, are going to need to see reference customers from equivalent companies with successful mature AI solutions. Mm-hmm. So the likelihood of companies that provide the installation of AI solutions being AI companies probably not huge, but what we are going to see is the consulting companies will find a different life. They will also embed AI solutions in their toolkit. And so at these levels, I think it's very cheap. And you can see there's a lot of people are buying it.
And out of the space where a lot of companies do the tech consulting, why do you like Accenture?
So it has the broadest suite of offerings. So, we actually sold Infosys on a double and then went into Accenture quite a while ago. So we're sitting on, I think, still sitting on fairly significant gain for the original clients who bought it at the first tranche. And so what ends up happening is that the broadest offering, you've got the dividend increases, share buybacks, plus the multi-decade growth from the category. It's been very attractive.
Let's get to your next pick, which is Alphabet, very well-known name, clearly so far capitalizing on the artificial intelligence boom and making some money there with the recent earning.
Yep.
Is that why you picked it?
Yeah. So obviously you want to, as much as I'm calling out companies for just share prices for getting the AI inflection, I think what we've got here is this is a company that's a direct beneficiary given their storage networks. I'm talking cloud, everything, and they will be a direct beneficiary from AI. Their infrastructure is supporting that. So obviously it's expensive and it's going to grow into its multiple here, but you've got growth from cloud, 63% year over year. You've got the digital assets, 13% growth year over year. You've got YouTube, you've got digital properties, we're all attracting eyeballs. The CapEx program is massive. And they just introduced the dividend 2024. So it's becoming a dividend story. So I think there's some upside here for sure. And as you can see, the market tends to agree with it.
Let's get to your last pick then, which is S&P Global Inc. Out of New York. What do you like about S&P?
So it's just straight out of the gate. It's a dividend aristocrat, 50 consecutive years of dividend increases. I think that's good. But effectively what it is, as we've seen with AI, there is a sell anything that's non-AI, and capital came out of the name. You can see it gap down significantly. But if you're in the markets, you need market data. For commodities, you need it for the S&P 500, you need it for the Dow, you need their analytics, it gets fed through to you. There are other various properties that they have. And then obviously you've got the Capital IQ program, which is used quite extensively across the investment banking market. So it will just continue to benefit. When new ETFs get announced or launched, they have to get licensed and obviously have to get the data, get listed. So that's a beneficiary. And so it's a net beneficiary from inflation as well, indirectly.
So what's your theory, Darren, as far as all of these companies that have been pushed down by the AI concerns? Consulting is one you talked about. This is another which has its own sort of moat of information around information that it has. What is your theory as to which areas you would pick in that have been pushed back by the AI concerns that there is still value to be had?
So if you type in will S&P Global be harmed by AI, the answer is no. And I would suggest viewers do that. But ultimately, what you want to do is you want to look and see, do companies have moats? For example, I'm looking at a company at the moment that has proprietary data. The company is down on a non-AI consideration. But there is obviously people are considering that it might have AI. But if you have proprietary data that no one else has, how can you be disintermediated by an AI solution? Because AI needs the data. And if you don't have the data, then AI has no value. So that would be the first thing. And I think also you're going to have segments that are going to benefit, or companies are going to benefit from introducing AI solutions. Look at automatic data processing. Yeah. 1 in 6 companies, 1 in 6 employees in the US, they fund. Okay. They can roll AI solutions.
All right, got to leave it there. Darren Sissons, as always, thanks for coming in.
Thanks for having me.
Good to see you. And join us on Monday for Market Call. Ernest Wong's on the show, head of research at Baskin Wealth Management, taking your questions on North American large caps. That is Monday. Thanks for joining us. We'll see you back here then.